Hello, welcome to Chapter 13. Today we're going to talk about financial statement analysis and the different types of ratios that users use to perform financial statement analysis. The primary objective of accounting is to provide information useful for decision making. To provide information that supports this objective, accountants must consider the following: the users, the types of decisions, and information analysis. This is what we're going to talk about today. First, we're going to look at the difference between horizontal and vertical analysis. You may already be familiar with these, but didn't realize the terms that refer to them. So, horizontal analysis or trend analysis refers to studying the behavior of individual financial statement items or several accounting periods. Absolute amounts of particular financial statements may have many uses. So an example is financial statement users may use absolute amounts reported for research and development costs to judge whether a company is spending excessively or conservatively. However, it's difficult to judge the materiality of an absolute financial statement amount without considering the size of the company reporting it. For example, you may see that revenue increased from one period to the next by $42 million. But that doesn't mean anything unless you can understand it perhaps as a percentage, such as 15%. Percentage analysis involves computing the percentage relationship between two amounts. In horizontal percentage analysis, a financial statement item is expressed as a percentage of the previous balance for the same item. So for example, we can look here and see that 2018 versus 2017 was an increase of 12.5%. And the number calculation is down here. So we know now that sales increased $100,000 or 12.5%. Excuse me. And we also know that cost of goods sold increased much more than sales, resulting in a lower gross margin. Users would want to investigate why operating expenses decreased substantially despite the increase in volume. They decreased here. So we would want to know, okay, sales increased, but then our cost of goods sold went up by much more than our sales increase. So what's going on here? Vertical analysis uses percentages to compare individual components of the financial statements to a key figure statement. So this is also referred to as common size financial statement analysis. So typically in income statements, all items are usually expressed as a percentage of sales. So here you can see that sales is always going to be 100%. Our cost of goods sold is 67.8% of sales or 60% of sales in 2017. So you would expect these to remain consistent. So again, we would want to investigate why our cost of goods sold went up and our operating expenses went down as a percentage of sales. In balance sheets, all items are usually expressed as a percentage of assets. So again, you'll see total assets at 100%, and you'll see each individual item as a percentage of the total assets. On the liability and stockholders' equity side, it's going to be as a percentage of your total liabilities and stockholders. Again, you would expect the percentages to remain pretty consistent unless something unusual is happening. Ratio analysis involves studying various relationships between different items reported in a set of financial statements. I'm going to pause the video here, and I'm going to do several different videos based on the type of ratios that we're going to be talking about.